So let's talk about cash, short-term investments, and accounts receivable. They don't really have much of anything in common with each other than all being current assets and none being able to stand alone as a separate chapter in this sort of class. The bulk of the lecture will be spent on accounts receivable, where there's the greatest discretion involved. But first, let's talk about cash, since cash is the very first thing we see on the balance sheet. It's the most liquid of current assets, and while we saw last class that the timing of cash flow doesn't matter, we need to remember that without cash, our business is going to have a hard time staying open. Cash includes not just the cash that's sitting in the register, but also whatever we hold in deposit accounts with banks, the coins sitting in our vending machines, and even the money our receptionist keeps under the desk to pay for deliveries or cabs. We typically see the line item as being cash and cash equivalents, the cash equivalents being very short-term debt investments, typically having maturities of less than 90 days from the date of purchase. Within the accounting system, we will likely have a separate account for each of our bank accounts to minimize confusion. So if account 101 was our cash within our chart of accounts, we might have 101.1 being our Bank of America account, and 101.2 being a key bank account, and so on. From an accounting perspective, there are just a couple of things to talk about. First, though, I want to highlight some issues. First of all, it should come as no surprise that cash, in whatever form it may be, is ripe for theft, both by employees and by others. We should always make sure that we have adequate safeguards for our cash so that it doesn't go walking out the door. For instance, most grocery stores only allow a single cashier on a register at any given time. They are given a tray with money, they go and do their shift, and then they bring their tray back to the cash room to be counted. The cash room is locked and has a peephole so that no one gets in who isn't allowed to be there. And, depending on the size of the operation, the person counting the money when it comes back isn't the same person who gets the report about how much cash ought to be there. When I was in college, I worked in the photo lab at a Sam's Club in Houston. This was way back before they accepted credit cards, other than Discover, so they did a huge cash business. Once an hour or so, someone would push a shopping cart with a wooden lockbox in it, and cashiers would take all their large bills, zip them into an envelope, and slide them into the slot in the box. What makes this memorable to me was the fact that there was always an off-duty county sheriff walking alongside the cart, with his hand on his gun. This isn't the main Sam's Club, this is Texas we're talking about. They don't mess around. So keeping control of cash is a very important thing for us to do. The second thing is that while we need cash to run our business, it is possible for a business to have too much cash. How is this possible, you may ask? Well, let's think about what we get from having cash. Our cash sitting in the bank account earns what? 2%, 3%, maybe if we're lucky? What do the stockholders expect for a return? 8%, 10%, 12%, probably more. So to the extent that we have money sitting in a bank account, we aren't meeting shareholder expectations. And what happens then? We get fired. No! Cash management is an important part of our business. That is, making sure we have enough cash to meet our obligations, but not having so much cash that our performance is hamstrung. There are consultants whose entire careers revolve around that sort of activity, so we'll leave it at that. Just be aware. There are two things regarding cash that we will talk about. The first is petty cash, and this involves the money that we give to Marge, our receptionist. There are times when we might need a couple of bucks here or there, and it's not worth cutting a check, or perhaps the post person won't even accept a check. So we leave some small amount of money in Marge's custody. We've taken the money out of the bank and put it into a little box. This is still cash, of course, and will be included in cash on the balance sheet, but it will get its own account within the accounting system. Whichever bank account we took the money out of, that account needs to be reduced with a credit. There's one asset going down. A new account called petty cash will be created and will be debited. So within the accounting system, all we did was slush money from one account to another. Our financial condition hasn't changed. The petty cash account is an imprest account, which means that it will sit with that $100 in it forever, until either we decide to give Marge more responsibility and increase petty cash, or we give her less and decrease how much she has. As she disburses money, she will keep receipts, and at any point in time the cash in the petty cash bin, plus the total of the receipts, should be equal to that original imprest amount. In this case, $100. When the money starts to run low, we replenish the account with fresh cash from the ATM or the bank or whatever. The cash comes out of the account, just like it did when we set up the account, but rather than debiting the petty cash account again, we recognize as expenses all the things for which Marge used the money. We can't debit petty cash again, because if we did, the petty cash account would say 177, and we know that's not true. To the extent that Marge is crooked or not so good at math, and the cash plus receipts doesn't equal 100, we'll plug the difference into an account called over and short, and that will slide into the income statement with the rest of the expenses. We keep over and short separate so it doesn't pollute any of the other accounts. The second thing for us to do related to cash is the bank reconciliation. At the end of the year, when we report the cash on the balance sheet, we need to report not the cash we think we have, but the cash that we actually have. That is, just because our ledger says we have X in cash doesn't mean that's what we really have. There are things that go into our bank accounts that we don't know about until we get our bank statement in the middle of January. So the reconciliation does two things. First of all, it adds a layer of security to our cash controls. We get the heads up if someone has been stealing from us. But it also allows us to more accurately report cash for the balance sheet. On the off chance you haven't balanced a checkbook, we'll take a few minutes to go through the process now. I personally am a terrible accountant and haven't balanced a checkbook in 15 years or so. Instead, I married a doctor. Balancing the checkbook for me is getting the ATM slip out of the machine and saying, "Yeah, that's enough." Dave's first bit of career advice: marry a doctor. Dave's second bit of career advice: marry a doctor after they've chosen their specialty. When my wife and I first started dating, she was going to be a neurologist, which would have been awesome because first of all, ka-ching, and second of all, she'd spend all of her time working, so I'd be the only one to spend the money. And then she came home from med school one day and said, "I don't think I want to be a neurologist after all. I want to be a pediatrician and get paid a tenth as much." Crap! Anyway, I digress. So here's an example. We've got a general ledger balance of $860 on December 31st, and then a week or so into January, we get the bank statement, also dated December 31st, and it reports a balance of $2,567. And we see there are a number of inconsistencies between the two, which should account for the difference. So the first step is to look at each of these items and determine whether they indicate our book is wrong or if the bank is wrong. Once we've got all that sorted out, we'll be able to determine the true cash balance that belongs on the balance sheet. On the bottom of your notes is a worksheet to let us do our reconciliation. As we go through the list, we'll either add or subtract from either the bank or the book. So first, we've got outstanding checks. So those are the checks we wrote and mailed at the end of December and haven't been processed through our bank yet. So which is right, book or bank? Our book is right. Since we would have credited cash when we wrote the check, this is an adjustment to the bank. Subtract $2,250 from the bank balance. Outstanding checks. There. Next, we have interest paid by the bank. We see this on the December 31st bank statement, and we say, "Woohoo! We didn't know that. That's interest revenue. We were really $12 richer than we thought on December 31st. And the bank is correct, and the books are wrong. So we'll need to adjust our accounting system. For interest revenue, add $12 to our book. An NSF check from the customer. We were paid, we deposited the check, and then it bounced. When we received the check, we debited cash and credited accounts receivable, and now in hindsight, that was a mistake. We have to adjust our books. Our NSF check will be a minus 32. Deposits in transit. These are the opposite of those outstanding checks. We received checks from our customers, debited cash, and credited accounts receivable, and then stuck them in the deposit envelope. The checks hadn't been processed by the end of business on December 31st, however, so aren't in our bank statement. Our deposits in transit are a plus $1,900 to the bank. Service fee from the bank. Just like the interest, this is complete news to us. Unlike the interest, this is a boo-hoo sort of thing. We're actually $8 poorer than we thought. So, we've got our fee is a minus $8 on our books. There was a direct deposit from the customer. Typically, when we receive money, we debit cash and credit accounts receivable. However, this check bypassed us and went straight to the bank, so we didn't know we were supposed to record anything. We'll need to fix the books for that one. Our direct deposit check will be a plus of $1,400 to our books. Lastly, we screwed up recording a check when we wrote it. The check was for $615, but we only credited cash for $600. Oops. Got to make the adjustment to the books. Here's our error, and that's a minus 15. So now that we have classified each of these items as either an adjustment to our books or to our bank statement, we add them all up and we discover that the true cash balance was $2,217, and we add it up over here as well, and those two numbers should jive. That's going to be what we report on the balance sheet for our December 31st financial statements. Now, when we say that we need to adjust our books, it's not just on this little worksheet we did. We actually need to get this stuff into our accounting system, which means doing some journal entries. Each of those adjustments to the books will have their own adjustments. First, the interest. We debited our cash for $12. What should we credit it? Well, those $12 came free and clear of any obligations. That money now belongs to the shareholders. We'll increase equity by crediting interest revenue. Next, the NSF check. When we got the check, we debited cash and credited accounts receivable, and it turns out that we were wrong. So first, we've got to put that receivable back on the books. We'll go ahead and debit accounts receivable. The customer still owes us that money. Further, when we originally debited cash, we were wrong. We didn't receive that $32 in cash, so we're going to need to adjust our cash balance with a credit. That's going to decrease cash. We have the bank fee of $8, which is the opposite of interest. That fee is an expense, so we'll debit the expense. That cash has come out of our bank account, so we will need to credit our cash account for $8, and we're ready to move on. The direct deposit is our biggie. If the check had come to us, we would have debited cash and credited accounts receivable, but the check didn't come to us. So now we have to go back and record it as if it had, since we really do have those $1,400, and our customer really doesn't owe us anymore. So we will debit the cash for $1,400, and we will credit accounts receivable for $1,400. Lastly, we need to fix the typo. The check was for $615, not $600, so our accounts payable is too high. We're going to debit our accounts payable for $15. We don't owe them as much money as we thought we did. Why not? Well, because we actually wrote a check for more than we thought we did. We're going to have to reduce our cash account by $15 as well. All of these entries would be booked in January retroactively for our December 31st year end. The other inconsistencies we don't need to book journal entries for, since those were issues with the bank statement, not with our books. For what it's worth, when the auditor comes in, this same sort of thing can happen. Say the auditor comes in February and finds an error. They will require us to input a journal entry and push it back to December 31st in the exact same manner. Just because we're in the next fiscal year doesn't mean we can't still book entries for last year. In many cases, such as with bank reconciliations, there's no other way to do it. Now let's spend a few minutes looking at short-term investments and how we account for them. As I said in the second class, there are a couple of ways that we can look at an investment. One would be a short-term place to park cash, and by short-term I mean conceivably years, while we wait to sell it. The other would be a strategic investment along the lines of Coke owning stakes in its bottling companies. Those are long-term investments, and we will typically account for them in a completely different manner. So why are we investing anyway? Dave Corp is the world leader in the production and distribution of stuff. It's not a mutual fund or investment club. Why do they have short-term investments at all? Well, the answer comes back to what I said about having too much cash. Let's say we've been successful this year and have generated quite a bit of money. What can we do with that money? We've got a couple of options. We could reinvest it by expanding our business, but what if there aren't any attractive business opportunities available? Expansion should always be a strategic decision, not one born out of the presence of idle cash. We could pay a dividend, but that has a number of problems. First, if we pay that dividend, the money is gone for good. If we have our eye on some expansion a year or two down the line, we may want to keep access to that cash. Second, once we start paying dividends, shareholders expect it. And if for some reason we should need to cut our dividend payment, our stock price will suffer. We have already decided that leaving cash sitting around in a bank account is less than ideal from a return on investment perspective, so it makes sense that we might invest extra cash in the stocks or bonds of another company. These investments, by and large, are reported at market value. Remember my Indiana house? Forget my Indiana house. I can't forget my house. I still have nightmares about it. But that whole historical cost thing we talked about in Chapter 2 doesn't apply here. Let's buy some stock on November 31st, 2004 for $1,000. How should we record this? Well, what did we just do? We just wrote a check for cash. Cash went down and cash is an asset, so we're going to credit cash for $1,000. And what did we get in return? Another asset, specifically shares in Daveco, the world leader in the production and distribution of stuff. We'll record this at the original price, and it will sit there until December 31st, when we then discover that the stock has increased in value. It's now worth $1,500 instead of $1,000, and we want people to know what it's really worth. We want them to know that we could sell this for $1,500 and not the $1,000 we paid for it. Our general ledger currently has a balance of $1,000 in it, though. So what do? Well, here's our ledger, and here's our initial value of $1,000, and we know that's wrong. We want our balance sheet to say $1,500. So it seems to me the easiest way to make that happen would be to increase our investment account by $500. So we'll debit our investment for $500. We won't really. We'll actually use a holding account called Securities Fair Value Adjustment. That's this little guy right here, but that's close enough. Now what should we credit? Well, what is this $500? This is woohoo, right? We just came out $500 richer than we were before. And a woohoo, generally speaking, means we just increased our equity. So we'll increase our equity by crediting an unrealized holding gain on investments. It is a gain in that its value has gone up, but it is unrealized because we haven't sold it for cash yet. Now what do we do with this? Well, it depends. It depends on a decision we made when we initially bought this investment. Depending on how we choose to classify it at acquisition, this $500 gain could go straight to the income statement as other income, or it could bypass the income statement and go straight to equity. We would actually have on our balance sheet an unrealized holding gain on investments of $500. It's an increase in equity, an increase in wealth, but not net income. This is why we should pay attention to the statement of shareholders' equity, because the vast majority of short-term investments held by companies are typically classified under Option 2. If you go back to Chapter 2's handouts and look at the balance sheet, you'll see that Coca-Cola has a line titled Other Comprehensive Income, parentheses loss, and this is a sort of thing that's included in there. But Dave, why do we have these two options? If this is a gain, why don't we push it through to net income? Well, let's think about what the implications of that might be. Among other things, we use net income for contracting purposes. That is, many members of management receive bonuses based on net income, and to the extent that they don't, net income is still used in determining if we want to fire them or keep them employed with us. So say you're the CEO of Bob Corp, and you just bought some shares in Dave Corp, and then someone flies a plane into buildings, and the stock market tanks by 20%. What does that say about your ability to run Bob Corp? Not a whole hell of a lot, does it? So the decision was made that while we do want to make sure users have the decision-useful fair market values of these investments, we also want to insulate the income statement from the volatility of the stock market, which has little or nothing to do with the actual operations of the firm. Okay, Dave, I got it. But why did we do this at all, after all you went through with your Indiana house to prove the historical cost point? Well, the historical cost thing has to do with the tension between relevance and reliability. Fair value is relevant, but for most assets it's unreliable. Remember that with stocks and bonds, however, we don't have that trade-off. Because if I want to know what the value of a stock was on December 31st, all I have to do is go to the Wall Street Journal and look up the closing price, and I've got it. My shares are identical to the shares that were trading on the 31st, so I know with pinpoint precision what the value of my investment was at the end of the year. So in this case, we can get away with fair values. Now, on to the big topic of the class, accounts receivable. Here's where we're going to run into quite a bit of complexity, particularly since we'll be taking this opportunity to discuss some things about sales revenues as well. Obviously, we would like to have cash, but we don't live in a cash world. And chances are, even if we aren't extending credit to individual customers, we are probably extending credit to Bank of America on their behalf when they swipe their credit cards. So we have said it's okay to record the sale so long as we have done the work and reasonably expect to get paid with cash in the near future. And we already know what the journal entry looks like. We debit accounts receivable and we credit sales revenue. And of course, when we collect the money, we debit cash and we credit accounts receivable. Where do we start to run into some interesting things? The first thing would be cash discounts that we offer our customers. We would rather have cash from our customers than receivables because we can't buy stuff with receivables the way we can buy stuff with cash. So to encourage our customers to pay us more quickly, we will often give them an incentive to do so, and we call that a cash discount. These cash discounts are typically expressed in the following terms, with X being the percent discount, Y being the discount period, the number of days within which they pay us, they'll get that discount, and Z being the number of days after the sale that the balance is due. We will typically see 210 net 30 or something along those lines. That's relatively common. In this particular case, what we mean is that we would get a 2% discount on anything that we pay within 10 days. The full balance is due within 30 days regardless. Returning to the $100 of sales that we booked on the previous slide, let's say that we made that sale under the 210 net 30 terms and they pay us within the discount period. How much cash will we be receiving from them? Only 98, right? That was the deal. If they pay us in 10 days, they get 2% off, and that's $2. What should we credit accounts receivable for? In this case, we're going to credit it for the full 100. Why is that? Well, because they used to owe us $100, and now they don't owe us anything. If we credited accounts receivable for only 98, there would still be a $2 asset there for which we are never going to receive cash, so that doesn't make any sense. We've got to credit accounts receivable for 100. What do we do with the remaining 2? We'll plug it into an account called sales discounts, which is a contra revenue that's paired with sales the same way accumulated depreciation was paired with fixed asset. Our income statement will say that we have net sales of $98 right here. We track this separately so we can see that we sold $100 worth of stuff even though we only got paid $98. This can be helpful if we're tracking sales quotas or want to compare period to period, controlling for how much our customers took advantage of our discounts. Now, when I was in college, one of my accounting professors told us that everyone takes the discount regardless of whether or not they paid within the discount window. So when I went out to work, I conducted an informal poll of some of my clients. The statistical validity isn't so good because the sample size was only 2. The first client I asked looked at me as if I was an idiot and said, well, of course, if they're willing to take $98 today, they'll take $98 next week, and they'll take $98 next month. And if they don't like it, we'll buy from someone else. Huh, I said. Then I asked another client, and she looked at me as if I were an idiot and said, of course not. If we don't pay within the discount period, we don't deserve the discount. So, your mileage may vary, but there's at least a subset of businesses who look at the discount as being a blanket discount rather than one being available for early payers. If I had to go out on a limb, I would think that the former is probably more prevalent than the latter, but I could just be making that up. What else falls into this sort of category, where we are ultimately getting paid less than the original amount of the sale? Well, sometimes we're going to have items that are flawed, and we're going to have items that are just out and out horrible. And when that happens, we're going to get an angry phone call from our customer. In some cases, the flaws won't be so bad that we can't convince them to keep the merchandise at a lower price. In some cases, they're just going to send the stuff back, and that'll be the end of it. In both cases, we need to recognize that we are not going to realize as much from the sale as we thought, and we need to recognize that our receivable from them is not as great as it once was. I was at a Goodwill store a couple of years back, and they had this big bin of socks at the checkouts. And the socks were these cute little white things with a shooting star and a rainbow coming out of it. And the text on the sock said, like a straw. And I couldn't help but chuckle at the irony that one of Goodwill's services is job training, because someone probably was looking for a job after that. But here's a product that that fulfills its basic function. It's a sock. It keeps your piggies warm. And yet whoever ordered these socks would clearly not have been willing to pay full price for them. So we have to know how to deal with this sort of thing. Let's look at a numerical example. When I teach this course, I always bring in some munchkins from Dunkin' Donuts. So if you'd like the full classroom experience, pause the recording and go get yourself some. I can wait. Welcome back. Let's assume that Dave Corp sells $500 of donut holes, a whole boatload of them, to BUA 400 Inc. on credit. If you don't pay me, you all get F's for the class. So let's book the sale. Debit accounts receivable for 500, credit sales for 500. We should all be comfortable with that. Let's leave the inventory part to the next class. So let's say that somehow 10% of the donut holes I shipped you had coconut shavings on them. And I don't even use coconut in my production facility because it's so nasty, so I have no idea how it got there. And you call me up and say this is unacceptable, and I agree, and you return those donut holes for a full refund. I sold you this stuff for $500, and you return 10% of it, which means you no longer owe me as much as we thought you did. You owe me 10% less. So we should have that reflected both on the income statement in net sales and on the balance sheet in accounts receivable. We will once again track this separately from sales, putting it into the sales returns account. This will act in the same way as the cash discount we did just a bit ago. If our income statement only showed the effects of the sale to BUA 400, it would be reported as net sales of $450. And why do we keep track of this separately? The same reason we always get when we ask that sort of question. Because it matters. Because we need to keep track of this so that we know how well we are or aren't meeting our customers' needs. And if we just push this right into sales, we would lose track of that information. So we will debit sales returns, and we will credit accounts receivable. You no longer owe me quite so much. So there's the sales return. Now you asked for apple filling, and I thought I'd do you a favor and I put raspberry in instead. And while you secretly agreed that I did the right thing, you did ask for apple, and so to take advantage of my kind and gentle nature, you asked for an additional discount. And I agree, because that's how I am, and I give you another 5% off. Once again, we need to reduce the accounts receivable balance, and this time we'll use the account called sales allowances. Once again, it acts in the same way as the sales returns and the cash discounts, but once again, we'll track it separately for our own internal usage. So we'll take 5% off the $450 remaining balance, and we've got the following journal entry. We will now report net sales from the transaction as $500 minus $50 minus $22.50 gives us $427.50 of net sales on our income statement. The next big issue regarding receivables is the question of collectability. When we make a sale on credit, we assume that the person we're selling it to is going to pay us. If we thought that they were going to stiff us, what would we do? Not sell to them, of course. So we've sold to a bunch of individual customers, individually all of whom we expect to pay us. But the reality is that a subset of those receivables will end up going uncollected. Someone is going to end up stiffing us. We know this. We don't know who it will be, but we know it will happen. And we're okay with it. We accept this risk because we know that we live in a credit world, and if we didn't extend credit to our customers, we would lose most or all of our business. So we've accepted getting stiffed as a cost of doing business on credit, because that has opened up revenues to us that would otherwise have been unobtainable. And if we know that one of the costs of sales today is that we're going to get stiffed in the future, matching tells us to recognize that expense now, when we made the sales, rather than waiting for the customer to default. So we're going to debit bad debt expense for our estimate of what will end up going uncollected. It would seem the easy thing to do next would be to credit accounts receivable, just as we were doing with those sales discounts and allowances above. Unfortunately, it doesn't quite work that way. You may have noticed that I stopped using the generic term accounts receivable and began to be more specific. Accounts receivable BUA 400. This is because there isn't a single accounts receivable account on your books. We report accounts receivable on the balance sheet, but when we talk about accounts receivable, what we're really talking about is the summation of all the little customer specific accounts. Accounts receivable A, accounts receivable B, accounts receivable C, and we'll change this guy over here. This will be accounts receivable BUA 400. And if you think about it, we have to do it that way. Because if we didn't, we'd have to keep track of which specific customer owed us how much somewhere else anyway. Without that, we wouldn't know whom we should send the bills, and we wouldn't know whom Rocky should go visit with a bat when they don't pay us on time. So we're doing it anyway. Let's just put it in the accounting system. So what this means is that we can't credit our accounts receivable as the other half of the journal entry that debits our bad debt expense, because we can't touch accounts receivable if we don't have a specific client account to adjust. And since no one has stiffed us yet, we have no idea whose individual account needs to be credited. So what do? We introduce the account called allowance for uncollectible accounts. This is also called allowance for doubtful accounts and is often abbreviated as just allowance. And the allowance account is our we don't know who's not going to pay us account. We know that someone isn't going to pay us. And so we should reflect that both on the income statement through bad debt expense and on the balance sheet through a lower receivable balance. But we don't know who the bad guy is yet. So we do indeed debit our bad debt expense for the reasons we discussed above, but rather than crediting accounts receivable directly, we will use this holding account called the allowance, and that's where we will park our expected future losses. Note the effect of the journal entry. We reduce our equity with our debit to the expense. Here's money that the owners are going to lose. And we reduce our assets with a credit to the allowance account. Here's another contra asset, just like the accumulated depreciation last class. What do we report on our balance sheet? Well, just like how we subtract the accumulated depreciation from the asset's cost and report our fixed assets net, we will subtract the allowance from our accounts receivable balance and report that amount net as well. We call this net realizable value. Accounts receivable minus the allowance. And that's what shows up on our balance sheet. Financial statement users don't care so much about what people owe us, our raw accounts receivable. What they care about is how much cash we're going to get from those accounts receivable, and that's accounts receivable minus the allowance. Go back and look at the Coke balance sheet we used in Chapter 2, and you can see an example. This entry is not done in real time. We'll typically wait until the end of the period, and this becomes one of our standard adjusting entries, along with depreciation and the like. So let's say that we get a letter in the mail, and it's from BUA 400, and the letter says, "We ain't paying you. Go pound sand." Isn't that a great phrase? It's a pointless exercise. Go pound sand. Because what do you get when you pound sand? Pretty much just more sand. Anyway, we now know who it is that's going to stiff us. And what does this mean? It means that BUA 400 is going to get an F. It also means that we can finally go in and touch our accounts receivable, right? We open up accounts receivable BUA 400 and credit their account for however much we're going to get stiffed, in most cases all of it. So we credit the accounts receivable. What do we debit? We aren't going to debit the expense. Why? Because we do the bad debt expense up here as one of our adjusting entries. Rather, we'll debit the allowance for uncollectible accounts. Here's where things get fun. When we recorded the expense, we credited the allowance because we didn't know who wasn't going to pay us. And now we found out who it was. So, the we don't know who's not going to pay us account has too much money in it, and we reduce it with a debit. We used to know who it wasn't going to pay us, but now we do. And it's this guy. Note the effect of the journal entry here. We credit accounts receivable, decreasing our assets. And then we debit the allowance, increasing our assets. This has no net effect on our accounting equation. And this should make sense because when we find out that BUA 400 isn't going to pay us, the only surprise is that it's BUA 400. Not that we were going to be stiffed at all. We knew someone wasn't going to pay us, and we recognized that in the financial statements with our bad debt expense journal entry. All that we're doing now is eliminating the question as to precisely who is the guy. Now let's say that BUA 400 comes through after all. Huzzah! I play Dungeons & Dragons after all, so I tend to say huzzah a lot. And I smite things, but mostly say huzzah. So what do I do when this check comes in the mail from BUA 400 and I've already written off his account? Well, there are two things that we need to do. First, we need to fix an error that we made. When we wrote off his account, we said, aha, now we know who's not going to pay us, and took the money out of the we don't know who's not going to pay us account. That is, we debited the allowance. But it turns out that we were wrong. We thought we knew who it was, but it wasn't BUA 400 after all. BUA 400 paying us doesn't change our original estimate about how much we were going to be stiffed. It just means that we had the wrong guy fingered. What this means is that the person who isn't going to pay us is still out there, lurking, waiting to not pay us. So we need to put that money back into the we don't know who's not going to pay us account and put BUA 400's receivable back on the books. Debit accounts receivable and credit the allowance for doubtful accounts. There's the money going back into the asset and an increase in our allowance account. Again, no net effect on the financial statements. All that we've done is reverse the entry that we did on the prior page. This also means that we received some cash from BUA 400, so we should record that increase in cash and decrease in accounts receivable BUA 400 just like normal. Now it seems pretty obvious, at least to me, that with a little bit of math, we could cancel out a couple of items. We could cancel out this, and we could cancel out this. If we do that, it seems that what we're left with is a debit to cash and a credit to the allowance for uncollectible accounts. And yet we went through the trouble of both debiting and crediting that same accounts receivable account. Golly, Dave, that's a lot of work. Why did we do that? Well, the easy answer is because it matters, of course. You should know by now that's the stock answer to this sort of question. But why does it matter? Why don't we just debit cash and credit the allowance and be done with it? And the answer has to do with what I do the next time that BUA 400 calls me up and wants to buy some donut holes from me. If I don't go in and put that receivable on the books, how do things look right now? Am I going to extend credit to you? Of course not. You stiffed me last time. Why would I give you more stuff? So by going through this two-step process, we're able to properly reflect what that BUA 400 did in fact ultimately make good on the obligation to us. Maybe we won't want to sell to them again anyway, or maybe we'll limit the amount of credit we offer them, but at least we'll have the full information. Of course, the question now comes, where do we come up with that estimate? How do we know how much to debit the expense and credit the allowance? There are two basic ways for figuring this out, and both involve using our professional judgment. The first is the income statement method, and as you might guess from the name, the focus is on getting the income statement right. We're going to make sure that our matching is right, first and foremost, by directly linking our revenues with the costs of revenue generation. So, we'll calculate our bad debt expense by multiplying our credit sales by some expected default rate. Where did that rate come from? Well, good question. If we have prior experience, that would be our best bet. If we don't, trade publications would be the place to go. Hopefully, if you're in a business that's extending credit to customers, you've done some analysis to figure out expected loss rates. Note that we'll only use credit sales for our calculation, since the expected default rate on cash sales is, of course, 0. So here's our example. We've got $20,000 of credit sales and expected 2% default rate. What is our bad debt expense? The $20,000 of sales times the 2%, and we've got $400 of expense. We will explicitly calculate this number right here with the credit to the allowance going along from the ride. Debit bad debt expense and credit the allowance. From a comparability standpoint, using the income statement method ensures a consistent relationship between bad debt expense and sales from year to year. The downside is that our annual expense is based on experience from past years rather than the company's current receivable portfolio risk. This means that the amount in the allowance account could get out of whack if we aren't keeping a close eye on it. That is, say that the actual defaults over the last several years were actually only 1%. That allowance account is going to add up, and eventually the balance sheet's reporting of net realizable value will be all wonky. Obviously, this could go in the other direction too. The second method we can use to estimate our bad debt expense is the balance sheet method. Again, the name suggests the focus is on the balance sheet. Unlike with the income statement approach, where we tried to estimate bad debt expense directly as best we could, the balance sheet method says, let's see if we can't get our balance sheet to report the net realizable value of accounts receivable as accurately as possible. When someone looks at the balance sheet and we say, here are our accounts receivable minus our allowance for bad debts, they know that they are looking at a good estimate of how much cash is actually going to come in the door. So when we are doing our calculations, rather than estimating bad debt expense directly, we will instead estimate the amount of receivables we expect to go uncollected. And this is going to be based on the detailed analysis of our receivables portfolio. For instance, if our receivables are all current, they're all from sales within the last 30 days, we would expect to collect pretty darn close to all of them. However, as our receivables start to get longer in the tooth, the likelihood of cash collection decreases. Those receivables that are past due will probably collect a little less. Those that are more than 30 days past due, even less. Those receivables that are 90 days past due, good heavens, things are starting to look grim. So as an example, here's a sample accounts receivable aging. We have a total in our accounts receivable of $155,000. And this is broken down into less than 30 days, 2 to 3 month old, and greater than 3 month old receivables. Again, based upon past experience or trade publications or some other source of information, we've estimated the uncollectability of each of those chunks. The new stuff, we expect 98% collectability. So only 2%, or 1,500, will default. For the 2 to 3 month classification, we expect 90% collectability. And for the greater than 3 month category, we expect only 75% collectability, and we're going to have default of $7,500. When we add all these up, we expect total defaults of $14,000. So here's where we stand. We've got $155,000 of receivables, and we expect to get stiffed on about $14,000. What's our bad debt expense? Not $14,000. It depends on what's already in the allowance for doubtful accounts account. Our example says that we have a credit balance of $3,000, so let's go ahead and create our T account. 3 is our opening balance, and what do we want? We want an ending balance of 14. That'll allow us to report 155 minus 14 on our balance sheet, an estimate of how much cash we expect to collect. This means that our bad debt expense is a plug number to get the T account to work. If we start with 3 and we want to end with 14, the only way we can make that happen is with a credit of 11. So our journal ends up being a debit to bad debt expense and a credit to the allowance for $11,000. Let's say instead that the allowance account actually had a debit balance of 3 in it. This is completely possible since we write off accounts in real time, but only book those bad debt expense entries at the end of the period as an adjusting entry. In this case, if we have a debit of 3 and we need to have a credit of 14, what do? We're going to end up booking bad debt expense of $17,000. So we've got the balance sheet properly stated, but this means that the income statement will be a little more volatile, since the relationship between sales and bad debt expense will fluctuate rather than stay constant. This is the trade-off we make. We can't have both the balance sheet and the income statement right, so we have to ask ourselves, which do we want to be more accurate? In my experience, the balance sheet method is the preferred way of calculating our bad debt expense. If we're doing a significant credit business, we're probably already having someone do this sort of analysis for us to make sure that we're getting paid on time. Further, in my opinion, one of the most important uses of the balance sheet is the assessment of short-term solvency. So the closer we can get to the true values of our current assets and liabilities, the better. While the income statement method is expedient and relatively uncostly, I would expect that only the smallest businesses would be using this method. A word of warning about the balance sheet method, however. Those percentages need to be determined using a thoughtful approach, and not just the numbers that Dave, the accounting professor, put up on a slide for an example, because you know what? I just made those numbers up. We need to be mindful of our customer base and our industry when doing this analysis. I had a student in my BUA 400 class who ran a local healthcare business, which means that they do a huge business with Medicare and Medicaid. In most industries, if we haven't gotten paid after 180 days, it's probably time to throw in the towel and write that stuff off. In the healthcare industry, 180 days is par for the course. On the next page, I have reproduced the footnote related to bad debts for Citigroup from back in 2003. I haven't had the heart to go and look at more recent examples. I would expect that they are far worse. This is basically a roll forward of their allowance for doubtful accounts T account. Look at the column for 2003. The beginning balance is $11.1 billion in expected defaults. Holy cow! And that was before the credit market fell apart and Citi turned into a pig. Egad. They have it split out into consumer and corporate credit losses, and we can see that they booked bad debt expense of $7.3 billion. That's a boatload of credit cards, ain't it? Then what happened? Here are the write-offs. $9 billion of write-offs offset by $1.5 billion of recoveries. This is the debit to the allowance, credit to accounts receivable, and this is that two-step process where we brought it back on the books and then recorded the collection. Same deal for the corporate down here, and they ended the year with $12.6 billion in the allowance for bad debts. So this is some big money, and there's a substantial amount of judgment in this. Where did we get that 2%? We made it up. Sure, we thought about this quite a bit, but no matter how you look at it, that 2% isn't a hard and fast number, and there's a lot of discretion in its calculation. Should you be looking at companies in the same industry, and one's bad debts are substantially out of whack from its competitors, it may not be, and probably isn't, because they're just that much better at collecting on their receivables. It's entirely possible that they are being a bit more aggressive in their bad debt estimates, and that can indicate that their other accounting policies may be aggressive as well. So look at the relationship between bad debt expenses and sales, or the allowance and accounts receivable. Analyze those relationships and compare them between firms. One last bit of crunchiness: credit card sales. These are going to be included in accounts receivable, but have their own little bit of funkiness associated with them. When our customer swipes their card and we make the sale, we've got a receivable, and that receivable is from the credit card company, and so we should just book that normally. When we get paid, though, we're going to find ourselves coming up short because the credit card companies charge a couple percentage points of fees for the privilege. We're going to find ourselves doing much the same thing we did back at the beginning of class with our cash discounts. When we get paid, we're only going to get $96 out of 100, yet we still have to write off the full $100 of receivables. What's that $4 difference? It's an expense associated with sales. We didn't have to accept that Visa card, but we chose to do so, and this is the price we pay for it. Sam's Club didn't used to accept credit cards for years and years, and now they do. They decided that the fee was worth the increased sales. If we wanted to be perfect little matching accountants, we'd want to book that expense at the same time as the sale, recognizing only $96 of receivables and putting that $4 of expense up here. But the reality of credit cards is that we get paid on a daily basis, and in some cases we get our cash wired to our account several times a day, so there's no real worry about misstatements. Lastly, we're going to talk about a couple of financial statement analysis tools to help put the numbers on the financial statements in better context. From here until Chapter 10, we'll have a little bit of this at the end of each class. Keep in mind that this class is not an analysis class. If you're interested in that, I encourage you to take it as an elective, either here or wherever you pursue your graduate work. Even so, there are a number of things we can look at and make sense of, even with the limited knowledge that we have. So when we're thinking about our current assets, we should immediately be thinking about solvency, the ability to pay our debts as they come due. There are two main ratios that we use to do this sort of analysis: the current ratio, which we spoke back in Chapter 2, and the quick ratio. As a reminder, the current ratio is current assets divided by current liabilities, and if that number is less than 1, it means that we do not have sufficient liquid assets to pay our liabilities in the short term, and that's not a particularly good thing. The quick ratio is a supplement to the current ratio. We calculate it the same way, but we only include our quick assets, which are our cash, our short-term investments, and our receivables. We exclude inventory because getting cash out of that is predicated on finding a buyer, and depending on what that stuff happens to be, that may not be an easy thing to do. We also exclude our prepaids, like that prepaid insurance from Chapter 3, because chances are that will never actually be turned back into cash. The checks were written, and now we're going to use up that rent, insurance, or whatever. The quick ratio is clearly a more strict ratio, but highlights to what extent our apparent solvency is based on inventory versus assets that can be used to pay bills in the much nearer term. Because what if we have a warehouse full of crap that no one wants to buy? We're not going to be getting a lot of cash out of that. A couple of other things. Our accounts receivable turnover ratio, which is net sales divided by average accounts receivable. How quickly are we making sales on credit and turning them into cash? Our accounts receivable age is 360 divided by that turnover ratio, giving us an estimate of roughly how long it takes to collect from our customers. This adds to our portfolio of solvency analysis, since firms often have substantial accounts receivable and not so substantial amounts of cash. If it's taking us 90 days to collect cash off our receivables, that's a bad sign about our ability to generate enough cash to pay those bills as they come due. From an internal perspective, the average age of our receivables should approximate our credit terms. If we give our customers 30 days to pay, that should be our average age. If the age of receivables is substantially over 30 days, we need to analyze our credit procedures to make sure that we're not selling to overly risky clients and that we have appropriate follow-up with customers after the sale. On the other hand, if our average age is a lot lower than our credit terms, that could be an indication that our credit granting policies are too tight. If we sell to no one but Walmart, we'll always get paid. But we'll be missing out on sales to all the mom and pop stores, most of whom pay, and that can cost us profits. This is the end of Chapter 4. Next class, we will look at accounting for inventory and how the choices we make can have a significant impact on the financial statements.